fuel prices rise, remain elevated, and then rise again. For many households, this pattern is not experienced as a single event but as a sequence that repeats. Costs increase within a short period of time, do not return to earlier levels, and then adjust upward again when the system encounters another disruption. The repetition is not random. It reflects how the fuel system operates when it is unable to restore balance between supply, inventories, and demand. By late April 2026, fuel prices in the United States had already moved into a higher range, with national averages around $4.18 to $4.23 per gallon and higher levels in some regions, including approximately $5.97 in California. That increase followed a reduction in refining capacity of roughly 800,000 barrels per day. When that capacity was taken offline, the amount of fuel entering the system declined. Demand did not fall in response. The system adjusted through price. This is the beginning of the cycle. When supply declines quickly and demand remains stable, prices respond immediately. The adjustment is direct because there is less fuel available to meet ongoing consumption. The system reflects that imbalance without delay, and the result is a rapid increase in price. This phase is visible and widely recognized. The change appears at the pump and is experienced directly by households. However, this initial movement is only one part of a larger sequence. Once prices have adjusted upward, the system enters a second phase that is less visible but more persistent. For prices to decline in a sustained way, supply must recover and inventories must rebuild. These two elements determine whether the system can return to a more balanced state. By the time prices had moved above $4 per gallon, inventories across multiple fuel categories had already declined. Gasoline inventories were down by approximately 6.1 million barrels. Crude inventories had fallen by about 6.2 million barrels. Diesel supplies had declined by roughly 4.5 million barrels. These reductions indicate that the system was relying on stored fuel to compensate for reduced production. Inventories perform a structural function. They absorb the difference between supply and demand, allowing the system to continue operating without immediate changes in price. When production falls short, inventories are used to maintain continuity. When production exceeds demand, inventories are rebuilt. The effectiveness of this mechanism depends on the level of those inventories. When inventories are sufficient, the system can absorb disruptions and gradually return to balance. When inventories are reduced, that capacity is limited. The system becomes more sensitive to imbalance, and recovery becomes more difficult. By late April, inventories were not only lower, but still declining. This indicates that the system had not reached a point where it could begin rebuilding its reserves. Instead, it continued to rely on them to maintain supply. At the same time, refining capacity had not fully recovered. The earlier reduction of approximately 800,000 barrels per day remained in effect. Refinery utilization was reported at around 89.6%, indicating that active facilities were operating at a relatively high level. However, utilization reflects only the capacity that is currently in operation. It does not account for the capacity that remains offline. As a result, total output remained below what would be expected under full operating conditions. This creates a limitation on recovery. Even if demand remains stable, the system cannot increase supply quickly enough to rebuild inventories while also meeting consumption. The process of restoring balance is delayed. Another factor influencing this process is the continued level of exports. Crude oil exports were measured at approximately 6.44 million barrels per day, and total fuel exports reached around 14.18 million barrels per day. These flows represent fuel leaving the domestic system while inventories were already being drawn down. Exports are part of normal market operations, but their effect depends on the condition of the system. When supply is sufficient and inventories are stable, exports do not create significant pressure. The system has enough capacity to meet both domestic and external demand. When supply is constrained and inventories are declining, exports reduce the amount of fuel available for domestic use. This contributes to the overall tightening of the system. Fuel enters the system at a reduced rate due to constrained refining capacity. Fuel leaves the system through consumption and exports. The difference is absorbed by inventories. As inventories decline, the system loses its ability to compensate for imbalance. This is how the second phase develops. Prices do not fall quickly because the system does not have the buffer required to absorb change. Instead of stabilizing, the system continues to operate with reduced reserves. Each unit of fuel consumed is replaced more slowly, and the overall level of available supply remains tight. At this stage, the system has not returned to balance. Supply has not recovered to previous levels. Inventories have not begun to rebuild. The flow of fuel remains constrained. These conditions define the environment in which the system operates. The third phase begins when a new disruption occurs within this already constrained system. Because inventories are reduced and refining capacity remains limited, the system has less ability to absorb additional shocks. When supply is disrupted again, the response is similar to the initial phase, but it occurs from a weaker position. Prices adjust upward again. This is where the pattern becomes visible. A disruption reduces supply and causes prices to rise. The system relies on inventories to maintain continuity, reducing its buffer. Recovery is delayed because production remains constrained and exports continue. Prices remain elevated. When another disruption occurs, the process begins again from a position of reduced stability. This sequence forms a cycle. It is not a series of isolated events. Each phase is connected to the next through the condition of the system. The system does not reset between disruptions. Instead, it carries forward the effects of each phase into the next. For households, this cycle is experienced as repetition. Costs increase, remain elevated, and then increase again. The expectation that prices will return to earlier levels is delayed because the conditions required for recovery are not present. This pattern affects not only fuel purchases, but also the broader cost of living. Fuel is a foundational input in transportation. As fuel prices rise and remain elevated, the cost of moving goods increases. Over time, these costs are incorporated into the pricing of goods and services. The transmission of cost follows a consistent path. Fuel prices increase. Transportation costs increase. Distribution costs increase. Retail prices adjust. This process is gradual, but it reflects the condition of the system. As the cycle repeats, the effects accumulate. Costs do not return to previous levels before the next increase occurs. Instead, each phase builds on the previous one. The system operates with reduced flexibility, and the margin for adjustment becomes smaller over time. At the same time, the reduced level of inventories increases the system's sensitivity to change. When inventories are high, the system can absorb fluctuations without significant impact. When inventories are low, even small changes in supply can affect pricing more directly. The system becomes less stable, and price movements become more pronounced. This instability contributes to the repetition of the cycle. Each disruption occurs in a system that is already under pressure. The response is faster, and the recovery is slower. The difference between these two phases defines how prices behave. Prices rise quickly when supply is disrupted. Prices do not fall at the same speed because the system requires time and capacity to rebuild balance. When that balance is not restored, the cycle continues. By early May 2026, the data indicates that the system had not yet reached a point of recovery. Refining capacity remained below full levels. Inventories across gasoline, crude, and diesel remained reduced. Exports continued at elevated rates. These conditions prevent the system from generating the surplus required to restore balance. Without that surplus, inventories cannot rebuild. Without inventories, the system cannot absorb change. Without that ability, each disruption leads to a similar outcome. The cycle repeats. For households, this repetition shapes how costs are experienced over time. Fuel prices remain elevated. Goods that depend on transportation reflect higher costs. Budgeting becomes more difficult as variability increases. The pattern is not temporary. It reflects the structure of the system. The system continues to operate, but it does so under constraint. And as long as those constraints remain in place, the sequence does not change. The continuation of the cycle depends on whether the system can rebuild the conditions that allow it to stabilize. By early May 2026, those conditions had not been restored. The system was not transitioning back to balance. Instead, it remained in a state where the same constraints that caused the initial price increase were still active. The most important of these constraints is the level of inventories. Inventories are the system's primary mechanism for absorbing imbalance. When production falls short, inventories are used to maintain supply. When production exceeds demand, inventories are rebuilt. This process determines whether the system can recover after a disruption. By late April, inventories had declined across all major fuel categories. Gasoline inventories were down by approximately 6.1 million barrels. Crude inventories had fallen by about 6.2 million barrels. Diesel supplies had declined by roughly 4.5 million barrels. These reductions indicate that the system had been drawing from its reserves to compensate for reduced refining output. This creates a condition in which the system no longer has sufficient buffer. When inventories are reduced, the system becomes more sensitive to changes in supply. It has less capacity to absorb fluctuations without affecting price. Each unit of fuel consumed must be replaced more quickly to maintain balance, but the system is not producing enough to achieve that. At the same time, the constraint that caused the initial imbalance had not been resolved. Refining capacity remained reduced by approximately 800,000 barrels per day. Even though refinery utilization was reported at around 89.6%, this figure reflects only the capacity that is currently active. It does not account for the capacity that remains offline. As a result, total output remained below the level required to rebuild inventories. This is a critical limitation. For the system to recover, production must exceed demand for a sustained period. That excess supply allows inventories to rebuild and restores the system's ability to stabilize. Without that surplus, inventories continue to decline or remain at reduced levels. The system remains in a state of constraint. Another factor reinforcing this condition is the continued level of exports. Crude oil exports were measured at approximately 6.44 million barrels per day, and total fuel exports reached around 14.18 million barrels per day. These flows represent fuel leaving the domestic system while inventories were already being drawn down. Exports are part of normal market operations, but their impact depends on the condition of the system. When supply is sufficient and inventories are stable, exports do not create significant pressure. The system can meet both domestic and external demand. When supply is constrained and inventories are declining, exports reduce the amount of fuel available for domestic recovery. This creates a persistent gap. Fuel enters the system at a reduced rate due to constrained refining capacity. Fuel leaves the system through consumption and exports. The difference is absorbed by inventories. As inventories decline, the system loses its ability to compensate for this imbalance. This interaction between reduced production, declining inventories, and sustained exports defines the second phase of the cycle. The system does not stabilize because it cannot rebuild its buffer. Instead, it remains in a condition where supply is only sufficient to meet current demand, or slightly below it. Without surplus supply, there is no mechanism to reduce prices in a sustained way. This is why the system does not reset between disruptions. Each new disruption occurs in a system that is already under pressure. Inventories are lower than before. Production remains constrained. Exports continue to draw supply outward. The system has less flexibility with each cycle. This reduced flexibility affects how prices behave. When a new disruption occurs, the system cannot absorb it gradually. Prices respond quickly because there is no buffer to offset the change. At the same time, recovery remains slow because the system lacks the capacity to rebuild supply. The difference between these two responses creates the pattern. Prices increase rapidly in response to disruption. Prices decline slowly, or not at all, because the system cannot restore balance. This pattern repeats because the underlying conditions remain unchanged. For households, this repetition is experienced as a sustained period of higher costs. Fuel prices do not return to earlier levels before the next increase occurs. Instead, they remain elevated, and the next disruption pushes them higher again. The cycle does not allow for a full recovery between events. This has a cumulative effect. Each cycle builds on the previous one. Costs remain elevated across multiple periods, and the overall level of expenses increases over time. The system does not return to a lower baseline before the next adjustment occurs. At the same time, the persistence of higher fuel costs affects other parts of the economy. Transportation relies directly on fuel. As fuel costs remain elevated, the cost of moving goods remains elevated. This affects distribution networks, which operate continuously and cannot reduce activity in response to short-term price changes. The effect moves through the system. Fuel costs remain high. Transportation costs remain high. Distribution costs increase. Retail prices adjust. This sequence reflects the connection between the fuel system and the broader economy. The repetition of the cycle means that this process does not occur once. It occurs multiple times. Each cycle reinforces the previous one. Costs do not return to earlier levels before the next increase occurs. Instead, they remain elevated and continue to influence the pricing of goods and services. At the same time, the reduced level of inventories increases the system's sensitivity to additional disruptions. When inventories are high, the system can absorb unexpected changes in supply without significant impact on price. When inventories are low, even small disruptions can produce noticeable effects. The system becomes more reactive. This increased sensitivity contributes to the repetition of the cycle. Each new disruption produces a similar response because the system has not regained its capacity to absorb change. The pattern continues because the underlying conditions have not been resolved. By early May, the data indicates that these conditions remained in place. Refining capacity had not fully recovered. Inventories remained reduced across gasoline, crude, and diesel. Exports continued at elevated levels. These factors prevent the system from generating the surplus required to restore balance. Without that surplus, inventories cannot rebuild. Without inventories, the system cannot stabilize. Without stability, each disruption leads to a similar outcome. For households, the effect is not limited to a single period. It extends over time. Costs remain elevated across multiple cycles. Price increases are experienced quickly, while declines occur slowly or not at all. The overall pattern reflects the structure of the system rather than a temporary imbalance. The system continues to operate, but it does so with reduced flexibility. That reduction in flexibility defines how prices behave and how those prices are experienced in everyday life. As long as these conditions remain, the cycle continues. The final stage of the cycle is not defined by a new disruption, but by the absence of recovery. By early May 2026, the system had not rebuilt the conditions required to return to balance. The factors that drove the initial increase in fuel prices remained in place, and the mechanisms needed to reverse that increase were still limited. This stage determines whether the cycle ends or continues. For the cycle to break, the system must rebuild its buffer and restore its capacity to absorb change. That requires inventories to increase and refining output to recover to a level where supply can exceed demand for a sustained period. Without that surplus, the system cannot return to a lower cost equilibrium. The available data indicates that this process had not yet begun. Inventories remained reduced across gasoline, crude, and diesel. Gasoline inventories had declined by approximately 6.1 million barrels, crude inventories by about 6.2 million barrels, and diesel supplies by roughly 4.5 million barrels. These reductions reflect ongoing reliance on stored fuel to maintain supply, rather than a transition toward rebuilding reserves. At the same time, refining capacity had not fully returned. The earlier loss of approximately 800,000 barrels per day continued to limit output. Even with utilization near 89.6%, the system was operating below its full capacity because part of that capacity remained offline. This constraint prevents the system from increasing supply at the rate required to rebuild inventories. The presence of crude production at approximately 13.6 million barrels per day does not resolve this limitation. Crude must be processed into usable fuel before it can enter the supply chain for consumption. When refining capacity is constrained, the system cannot convert available crude into gasoline and diesel at the necessary scale. This delays recovery and reinforces the existing imbalance. At the same time, exports continued to reduce the volume of fuel available for domestic use. Crude oil exports remained at approximately 6.44 million barrels per day, and total fuel exports reached around 14.18 million barrels per day. These flows represent fuel leaving the system during a period when inventories were already reduced. When supply is constrained, exports limit the amount of fuel that can be used to rebuild domestic reserves. This creates a condition in which recovery is not only delayed, but constrained by multiple factors operating at the same time. Supply cannot increase quickly due to refining limitations. Inventories cannot rebuild because there is no sustained surplus. Exports continue to draw from the available supply. These elements prevent the system from restoring its buffer. Without that buffer, the system remains sensitive to change. This sensitivity affects how prices behave over time. Prices remain elevated because the system cannot generate the conditions required for a sustained decline. At the same time, prices become more responsive to additional disruptions because there is less capacity to absorb them. The result is a continuation of the cycle. A new disruption does not occur in isolation. It occurs within a system that is already operating under constraint. Inventories are lower, production remains limited, and exports continue to reduce available supply. The system has less flexibility than it did before the previous disruption. When the next disruption occurs, the response follows the same pattern. Prices increase quickly because the system cannot absorb the change. Recovery remains slow because the system cannot rebuild its buffer. The cycle repeats from a position of reduced stability. For households, this repetition creates a sustained cost environment. Fuel prices remain elevated across multiple periods. The expectation that prices will return to earlier levels is delayed because the system has not restored the conditions that supported those levels. Each cycle reinforces the previous one, and costs remain higher over time. This effect extends beyond fuel. Transportation costs are directly linked to fuel prices. As fuel prices remain elevated, the cost of moving goods remains elevated. Distribution systems continue to operate, but the cost of that operation reflects the higher price of fuel. Over time, these costs are incorporated into the pricing of goods and services. The transmission of cost is consistent. Fuel costs remain high. Transportation costs remain high. Distribution costs adjust accordingly. Retail prices reflect those adjustments. This process does not reverse quickly because the system does not rebuild its capacity quickly. The repetition of the cycle means that these effects accumulate. Costs do not return to previous levels before the next increase occurs. Instead, they remain elevated and continue to influence the broader cost structure of the economy. The system operates with less flexibility, and the margin for adjustment becomes smaller with each cycle. At the same time, the reduced level of inventories increases uncertainty. When inventories are high, the system can absorb unexpected changes without significant impact on price. When inventories are low, even small disruptions can produce noticeable effects. This increases variability in pricing and affects both businesses and households. For households, this variability makes budgeting more difficult. Expenses are not only higher, but less predictable. The pattern of rapid increases and slow or incomplete declines creates a cost environment that is difficult to anticipate. This effect is not temporary. It reflects the structure of the system under current conditions. The current state of the system can be summarized through the interaction of its key elements. Refining capacity remains below full levels, limiting supply. Inventories remain reduced, limiting the system's buffer. Exports remain elevated, reducing the volume available for recovery. These conditions define how the system operates. They explain why prices rise quickly when supply is disrupted and why they do not return at the same speed. They also explain why the cycle continues. The system has not restored the capacity required to stabilize itself. There is no indication, within the available data, that inventories have begun to rebuild at the scale necessary to change this pattern. There is no indication that refining capacity has returned to a level that would allow for sustained surplus. There is no indication that the flow of fuel has shifted in a way that supports recovery. As a result, the cycle remains in place. For households, the effect is already present in the persistence of higher costs and the repetition of price increases. The system continues to function, but it does so under constraint, and that constraint shapes how prices behave. Until the system rebuilds its buffer and restores its capacity to absorb change, the pattern does not resolve. Prices rise quickly when supply is disrupted. They do not return at the same speed because the system requires time, capacity, and surplus supply to recover. Those conditions are not yet present. This defines the current reality. The cycle is not breaking. It is continuing,